Good afternoon, ladies and gentlemen. I am Yashashri, the moderator for this conference. Welcome to the first quarter FY23 earnings conference call for Motilal Oswal Financial Services Limited. We have with us today Mr. Ramdev Agrawal, Chairman, Mr. Naveen Agarwal, Director and CEO AMC, Mr. Ajay Menon, CEO Broking, Mr. Shalibhadra Shah, Chief Financial Officer, Mr. Chetan Parmar, Head of Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to invite Mr. Naveen Agarwal to make his opening remarks. Thank you, and over to you, sir.
Morning, friends. It is my pleasure to welcome all of you to the Motilal Oswal Financial Services call for the first quarter of the financial year ending March 23. We hope that all of you and your families are safe and in good health. Let me take you through the key highlights of the operation and the financial performance for this quarter. In the first quarter, we reported an operating profit after tax of 182 crores, 1.82 billion rupees, which is a growth of 40% year on year. This is being driven by capital market business profit after tax growth of 16% year on year. Asset and wealth business profit growth is muted at 6% year on year on the back of the mark to market in the AUM that we saw during the first half of this calendar year, which had its full impact in the first quarter of the financial year. And finally, the housing finance business reported very strong near 3.7x in profits year on year at 32 crores, 32.1 crore rupees on the back of COVID provisions that were there in the base of the last year. And so this is a more normalized run rate of the profitability of the home finance business. Our consolidated net worth stood at 56.5 billion rupees. Net debt is at 41.6 billion rupees, and net of all the investments that we've made in various products of the firm, we have a net cash balance sheet. We have also successfully completed the third buyback of the firm since its listing of 14.5 lakh shares aggregating to 200 crore rupees. Ever since our listing back in 2007, we have never issued shares in either the parent company or the subsidiary, and have only engaged in buybacks, effectively completing the third such buyback. The key highlights for the first quarter include that the capital markets business delivered consistent growth in various business parameters. We had a very strong growth of 160% year on year in the average daily turnovers, meaningful improvement in market share, particularly in the very significant F&O segment, growth in active clients and client addition led by meaningful traction in the digital acquisition channel, robust net sales in the distribution part of the business, growth in the funding book, and an investment banking mandate pipeline. Turning to the asset and wealth management businesses, we saw good traction of flows towards alternate assets. Our net revenue yield was intact at about 75 basis points during the first quarter. We launched newer products during this quarter in the asset management business. As far as the wealth management business is concerned, our net sales was 19.9 billion rupees, up by almost 88% year on year. Our largest ever private equity fundraise, India Business Excellence 4, with a target size of 45 billion, completed raise of 40 billion till date, and we expect to close the balance fund in the coming quarters. As far as home finance is concerned, we saw a pickup in our disbursements, 270 crore rupees, up by 84% year on year. We saw traction in login and sanction pipeline, expansion in our sales force and collection team, and continued diversification of the strong liability franchise that this business enjoys. Doing a little bit of a deep dive in these individual businesses, the capital market business comprises of retail broking, institutional equities, and investment banking business. Revenues for all these three businesses combined stood at 608 crores, up by 19% year on year. Capital market businesses accounted for 63% of the total revenues. Profit, as I mentioned earlier, was up by 16% to 909 million rupees in the first quarter, led by healthy volume growth of of almost 160% year-on-year, 24% quarter-on-quarter, and an improvement in our retail futures and options market share by 34 basis points on a quarter-on-quarter basis. In this business, we had a total 210,000 new clients acquired in this quarter, with traction witnessed in the online channel. NSE active clients have registered a 43% year-on-year growth at 930,000 numbers at the end of June of 2022. Our incremental demat account market share improved by 40 basis points quarter-on-quarter to 3.1%. Our trailing 12-month overall ARPU was at 24,000, which is among the highest in the broking business. Our strategy to bring in linearity through trail-based distribution business continues. The distribution AUM grew 23% year-on-year to 17,200 crores at the end of this quarter. Our distribution net sales were up meaningfully year-on-year at 380 crores. With only 16% of our 31 lakh retail client base tapped for a single cross-sell, we expect continued increase in the AUM and fee income over the coming quarters. Our interest income increased by 64% year-on-year to 140 crores due to increase in the margin trading funding book to 2,030 crores at the end of this quarter. We strengthened our digital ecosystem with focus on revamping the entire digital infrastructure. Set up a data science team. We reoriented digital business unit and launched multiple digital products through this business. Impact of some of these should come through in the coming quarters. In the institutional broking business, we've continued to see improvement in domestic client rankings. This has been a result of differentiated research products, wide coverage. Investment banking continues to enjoy a reasonably strong pipeline, although execution has been extremely weak. As you know, there have been hardly any IPOs in the market during the current quarter. Turning to the asset and wealth management business, our AUM across mutual fund, PMS and AIF stood at 43,400 crores. This was lower on a quarter-on-quarter basis because of mark-to-market. In fact, as I speak to you, our AUMs are now at about 46,000 crores before the end of July. Revenues for this business stood at 140 crores in the first quarter. Our equity mutual fund AUM stood at 27,400 crores based on this 434 billion end of the quarter number. We've seen improvement in performance of some of our flagship products. We added 47,000 new SIPs in the first quarter with traction witnessed in active funds, which saw a growth of double digit on a year-on-year basis. Our share of alternate assets continues to be at the higher end of the spectrum at about over 35% of our total AUM. Our private equity business AUM stood at 114 billion, 11,400 crore rupees across the three growth capital PE funds, the four real estate funds. In the first quarter, revenues grew by 35% year-on-year to 31.8 crores. Our first private equity fund had delivered an XIRR of 26%. Track record of the past funds performance both on the private equity growth capital as well as the real estate side has led to the largest fundraise IBF4, where out of the target size assets as and when we have an opportunity. To sum up, all of our businesses have delivered robust and sustainable performance in the first quarter amidst a challenging environment. Our retail broking business, which is our cash cow, has improved its market share and is benefiting from market expansion and industry consolidation. Our strategy to diversify our business model towards linear sources of earnings continue. Asset management business should gain because of some improvement in the performance of our products. Wealth management business has a lot of headroom to grow given the small size in the context of the very strong brand that we enjoy. The private equity business, as I mentioned earlier, raised the biggest fundraise on the back of very strong performances of the past funds. The home finance business has witnessed a solid turnaround in terms of disbursements improving, asset quality being under control, cost to income being reasonable, and is very well geared for building up from here given the low gearing and profitability of the business. We'll now open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Good afternoon. My questions are all on the home finance business. There has been a small, I'll just ask the questions sequentially. There's been a small tick up in GNPA, so I wanted to understand why. Secondly, I wanted to also understand your strategy in terms of construction finance, where you said it will be tied up with Motilal Oswal real estate, and what proportion of the book will be in such funding. And the third question was on the yield on or the interest rates charged to customers. Given the higher rates that are there in the market, have you been able to pass on hikes, and is it been with higher EMI, or did you need to lend in tenors? Thank you.
Yes. Yeah, good morning. Thank you for your question. So on the first point, in terms of the asset quality, so actually asset quality, if you look at it from the new RBI circular perspective, we stand from a quarter-on-quarter basis, the GNPA increase is only 19 basis points because we are still under the old method, and as of 30th September, this will get realigned. So the focus is on actually collecting the complete overdue EMIs, and that's why we are getting catched up to the new circular impact. Even in quarter one, the collection efficiencies have been improving month on month. So generally, the whole industry starts at a lower efficiency in April, May, which starts getting catched up in the month of June and onwards. So we are now almost over 100% collection efficiency. So that should help us to better have the collections on the 90 plus book. Even in terms of there is the asset quality, the increase in the NPA is also from a part of a restructured book because of that. So as we move out the curve, I think the overall collection efficiencies have been improving on the restructured book as well. On the construction finance strategy, construction finance, so we have a very strong track record of investing in Cat A developers from a real estate fund management team. So we already have a 5,000 crore assets under management in our real estate funds in our private equity business, where we have done almost 110 investments, and they have a very successful track record of exiting those investments at more than 20% IRR. So we'll be leveraging internal synergies to create a very strong, good quality construction finance book in our housing finance business as well. So while we have a good proportion of the retail housing finance book, so the idea is to create a meaningful non-housing book through funding the Cat A developers, and there we believe that this book will be close to 20% of our overall loan book. In terms of the yields, so while cost of funds for us, all our loans are driven by MCLR. So there is, as of now, banks have the average bank MCLR increases 35 basis points, and that impact would also actually come to us over next period of 9 to 12 months. So as the whole the MCLR increase bakes in our cost of fund, accordingly then we would take a call to increase the RPLR. So at this juncture there is no increase in the RPLR. Even across the industry, only one of the players in affordable segment have actually increased the RPLR. Rest industry has not yet increased. And we expect to maintain spreads over 5.5% in this business on a consistent basis.
Thank you very much. That answers all my questions, and good luck.
Thank you.
Thank you. We have a next question from the line of Raj Jha from Edelweiss Financial Services. Please go ahead.
Yeah, good afternoon. Congratulations for a good set of numbers. My question is more towards the retail broking business. As was mentioned by Naveen ji, that this is a cash cow business. So I would like to understand it on three parts. One is how the business was faring pre-COVID. Obviously, during the COVID time, there was a huge traction or aggression happened. And how the business is faring as of now. If you can break it on the run rate basis, the type of traction which was there, both from industry perspective and from Motilal Oswal perspective. If Ajay can answer that, this is Ramesh here.
So actually, as you know that the addition to the retail investor base has been quite dramatic in the last 3-4 years. And if you have attended any of our earlier calls, we have always cited that given the under-penetration of equities in India, you will have phases of 5-6 years when this base will multiply at least a few times over. That happened if you go back in time in the decade of 2000 to 2010, which also coincided with very strong corporate profit growth. And we were of the belief that this can again repeat itself in the current decade, and we also expect very strong profit growth. So if you look at the ADTO numbers, the ADTO numbers used to be 24,000 crores odd in the year ending March 20, which is the pre-COVID year, rose to 44,000 crores in the year ending March 21, 88,000 crores in the year ending March 2022, and in the first quarter, it has already doubled to 1.5 lakh crores. So I think typically there is a multiplication of the investor base, correct? And we believe that this number is still likely to multiply from here, from the current number as of 30th of June, and an even bigger increase in the ADTO, right? And with fewer and fewer players, or the market consolidating in the hands of fewer players, those who are on the right side of consolidation will see disproportionate capture of this strong growth in ADTO. Our own model is slightly different. As you know that we believe in cross-selling the more sustainable
So are they going for the NBFC route, funding route for broking business, or they are just pure cash which is coming in?
So it is a function of both. Actually, the clients are having their own money as well as they are taking the funding through the margin funding route. So as far as the regulatory framework is concerned, the client has to bring his own upfront margin. But over and above that, if he needs funding with the specified LTV, he accesses the margin funding route.
That I understand. I just want to know whether there is a traction in the other route, I mean margin funding route, or no? Or is it just a normal?
If you see, yes, that's right. Because if you see year on year, there is increase in the total funding book by 20% from Q1 of last year to Q1 of this year. But sequentially, the book has remained flat. But if you see over many years, there has been a meaningful improvement in the funding book. Our funding book stands at 2,039 crores.
Okay. Thank you so much for explaining me all the things. Have a good day and good luck for the future.
Thank you. Ladies and gentlemen, to ask a question, you're requested to press star and 1 on your phone. We have our next question from the line of Sameet Bansali from Tata AMC. Please go ahead.
Yeah. So the book breakup that you have shown in the presentation, what would be the 11% others part in the book?
So you're referring to which slide?
The breakup you have shown, right? There is 8% your commercial finance and more book. Then you have home improvement.
Right.
Overall book breakup, pie.
Yeah, that portion actually consists of loan against property.
Acha. Yeah. And in this construction finance book, what would be your typical average ticket size?
Average ticket size here is almost 20 to 25 crores.
Okay. And the NPA which has increased sequentially is more due to slippages from the restructured book. So any color on restructured book on where it stands and what amount has slipped from the restructured book?
Restructured book actually, if you see, there has been overall improvement. So as of now, the collection efficiency of that book stands at 82% versus the overall collection efficiency that we report. So there is marginal slippage from that book which is arising in this last couple of quarters from that book. So overall, we expect the slippage to be around 25% of that total book.
So overall, so can you share the quantum? What is the amount of restructured book?
The restructured book stands at 278 crores.
278 crores, okay. And lastly, as per the new norms, your NPA would have been around 2.8%. So if I have to compare it sequentially last quarter, would you have a similar number?
Yeah. So actually that number is 2.75% as per the new norms. And if you compare it sequentially, it is 2.56% in March end.
Okay. Okay. And any further higher impact on credit cost do you see due to transition to the new norms or recognition as per the new RBI norms in our P&L?
No, actually we have fully provided for that in quarter 3 and quarter 4 of last financial year. So we have actually fully baked in the new norms provisioning, because even if you see our stage 2 assets, they are actually provided higher as if the stage 2 assets are stage 3 assets itself.
Okay. And how is the book which you would have originated with the Motilal Oswal, the real estate team? How is it performing? Any initial trends that you are seeing there?
No, not at all. There is no overdue on that book. It is fully performing.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, to ask a question, you're requested to press star and 1 on your phone now. We have a question from KG from ISEC. Please go ahead.
Hi, this is Kajal from indirect. Hello, sir. Hi. So, wanted to understand, in your brokerage, you have mentioned that your ARPU is one of the highest. So, in that, what will be the share of sub-brokers that may be coming to you? And what's the formula that you are using for your ARPU calculation? Basically, the underlying.
So, formula used is trailing 12 months read by the active customers. And as far as the ARPU mix is concerned, so actually almost half of our business comes through the franchisee channel. So it's a blend of that which gets accounted in the overall ARPU.
And any color on your brokerage in terms of retail and institutional?
We don't give that out separately. So.
Okay. Then second question is, in the new customers which are coming on the platform, so how much are purely digitally acquired or other modes? And when we say digitally, it is like 100% on their own, or it's online and we assist. How is the client acquisition happening in the new customers? And whether most of them are coming under your flat brokerage or the discount plan?
First, we do not have any discount plan or a flat brokerage. We completely have an ad valorem structure as far as the client acquisition is concerned from any channel it is, whether it is acquired through a digital channel or through our franchising channel or through our PCB channel or through the branch. All have an ad valorem model. As far as the acquisition mix is concerned, almost 60% of the new clients are coming through the digital acquisition channel.
So there is no assistance across in this, it's thoroughly fully digital, or there is some assistance?
So it is through the fully digital channel, through the online lead generation route. So it's a fully digital route of acquiring customers.
Okay, sir. And have you seen any impact of this cash margins and full 100%, 50% cash margin for the intraday and all?
So actually, that is something which is a 50-50 rule which has come from 1st May. So if there is an ineffective client, in the sense that if he brings in a higher non-cash portion, so to that extent, the broker can meet the margin requirements. So we've not seen any impact because of that. In fact, it would only add to our funding revenue because the inefficiency would be passed on to the customer.
Okay, thank you, sir.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have a next question from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, good morning, everyone. First question is just on this rule change from 1st May. Can you elaborate exactly what the change is and what sort of impact it could have? Second, I see your funding book has stayed quite strong. I would have expected it to be more volatile, especially, given what is happening in the markets. So, what do you think is the reason for this resilience, and do you think it can sustain if markets continue to be, the way sort of they have been in Q1? Would you expect it to drop? Or the nature is something else. Maybe you can comment a little bit on that. And what is the net sales in the listed AMC business for the quarter? And finally, I'm not sure whether you've given the SIP numbers, or maybe I've missed them in the presentation. So maybe you give that out as well. Yeah, those would be my questions. Yeah.
Yeah, sure, Dan. So this, as far as the new 50/50 rule is concerned, which is effective from 1st May, what it means is that the form of margin was earlier required by the broker at an overall level to be kept at 50/50. It was not required by the clients to be brought in the 50/50 fashion. 50% cash component, 50% non-cash component. So say, for example, if the customer brings 100% margin in the form of shares, which is typically the case in our derivatives. So now the customer has to bring in 50% in the form of cash, or 50% in the form and 50% in the form of shares. But if he doesn't do that, still we as a broker can actually fund that exposure. So to that extent, in fact, as I highlighted in the earlier question, that would improve our overall funding and the interest income on the book. So that is the impact of the first change. So to that extent, today we have almost around 6 billion rupees of that mismatch, which we have actually funded through bank guarantees in the exchange. Coming to the second question on the
sorry, Shali, just on this. So when you fund this 50%, and so you charge interest to the customer on that. So 6 billion additional, in a way, you've given to the exchanges, right? So it's almost like margin funding in a way, right? So or against the shares, or sort of a T+5 or margin funding, whatever you want to call it. The money can be used anywhere. So he has the shares with you, 100% shares, for which you've given 50% in 50% funding for him to, through a limit.
Yeah. So actually, as far as the pricing concerned, because as the circular came in the month of May, so we had evaluated the whole impact, and actually from Q2 onwards, we will see the pricing implication to the customers on that. We were just trying to see how the book stabilizes, and from Q2, in fact, we have started passing on that cost to the customer. As far as the funding is concerned, it is not exactly like a margin funding, because this is given in the form of bank guarantee. So typically, you don't have to have the whole cash component borrowed for funding the customers.
And so is this amount included in the 20 billion loan book that you have shown?
So no, it is not included, because it's an off-market exposure through the bank guarantee.
Okay. So this will actually become 26 billion in a way.
Yeah, that's right.
Yeah.
So there's a difference in the pricing from the margin funding book to this, because the costs are lower for a bank guarantee versus a borrowing.
Yeah. Understood.
Coming to the overall funding book, so actually the funding book has been flattish on a quarter-on-quarter basis. So because the cash volumes have actually been down in the market by almost 23%. So we are seeing that impact. So while actually there was also some impact of the overall regulatory framework since last few quarters, right? So that given that on a year-on-year, still our focus has been to improve the margin funding book, and that is almost up 20% on a YOY basis. So the focus will continue, because the new clients that have come in and are becoming active. So we are also focusing on funding those customers, and so we'll see meaningful improvement of the increase in the funding book over next few quarters as well.
Well, despite the market volatility, it's held up well. Actually, I meant it in that way, that despite market volatility, it has held up well. And you expect it to continue despite markets not really doing that well.
Yeah, so actually the impact is in QOQ by the flattish. In fact, otherwise it would have grown if the cash volumes would have been better. So that is the overall impact. Coming to the question on the net sales in the AMC business, so actually the net sales stands negative at 2.7 billion. So that also includes actually the overall impact of the RBI regulations on not allowing the international investing in a couple of large passive funds. So to that extent, we have seen the overall flows getting negative because of the impact of the offshore investing. While there is a strong net flows on our alternative funds, that continues to be improving overall. However, because of the MF passive, there is an impact of minus 2.7 billion on the net sales.
And the outflows were seen more in PMS?
For PMS side, actually gross sales have been improving, in fact, year-on-year as well, and redemptions have been actually lowering, but overall net flow is negative.
Okay. And SIP numbers is not shared?
SIP numbers this quarter were 340 crores. As you know that about 300 crores of quarterly SIP flows into passive funds have been discontinued. And so this number is after that impact.
Right. Okay, understood. Yeah,
are now active flows.
Got it. Yeah, that's it from my side. All the best.
Okay, thank you.
Thank you. A reminder to participants to press star and 1 on their phone to ask a question. We have our next question from the line of Rushabh from Guardian Capital. Please go ahead.
Hi, sir. Good afternoon. So I had a couple of questions. First, what is the growth guidance we are looking for in next 2 to 3 years in terms of revenue as well as net profit? And secondly, we had a buyback call last month. So wanted to understand what was the buyback you meant for, and these are the 2 questions I had.
We don't really give out any guidances. As I articulated in the opening remarks, we're very optimistic about how the entire broking business can grow as there's more and more financialization of savings, and within that the share of equities has gone up, and we are a pure play on that across our various businesses. As far as the private equity business and the wealth management business is concerned, they have both seen very strong traction. The public markets asset management business has consolidated and the performance is improving. We are very hopeful that, like in the first round, we saw AUM build up from 1,000 to 50,000 crores. Our next leg will be equally exciting. As far as the home finance business is concerned, I talked about acceleration in our disbursements, very low gearing. Strong growth well above the market growth through internal accruals of that business should continue. So we see very strong growth in the capital market franchise on the back of our positioning where we are gaining market share. I gave you those numbers of overall gaining market share, also the F&O gaining market share. We spoke about the asset and wealth management businesses and the home finance businesses. All 3 of them, we believe, have a lot of headroom to grow in the coming years. What was your next question? Buyback. So buyback has been completed. 200 crores is the amount that was proposed, and that amount is fully done and completed during the current quarter. And
So I just wanted to understand what was the buyback for, and the buyback price was around 1,200 per share, whereas the current market price is around 700, if I'm not wrong. So wanted to understand the differential there.
Yeah, so actually the buyback was done through the tender offer route, where typically the buyback price was at 1,100 rupees, which was almost at around 25% premium to the current market price when the buyback was announced. So this buyback is typically where promoters have also participated in the whole process, and it's so actually if you say out includes dividends and also in the form of buyback.
Okay. Yeah. Okay. Thank you. Thank you so much.
Thank you. Ladies and gentlemen, please press star and 1 to ask a question. We have a next question from the line of Yash from Dante Equity. Please go ahead.
Yeah. Hi. Good morning. I just want to know more about the opportunities that you're looking at, whereas your PE division is concerned, and also as far as the housing finance business is concerned, what is your market view as interest rates are going up now? What is your market view there, or what is? I'm not asking for a guidance. I'm asking for a view, basic commentary. Please go ahead.
Sorry, you'll have to repeat your question. Unfortunately, your voice is...
Yeah, the first question. The second one we understood. The first one, what is it?
The first question is on your private equity management business. What are the kind of opportunities that you're looking at right now in this current market scenario?
So basically, as I mentioned to you, we have 4,000 crores of raise, out of 4,500 crores targeted raise. We've received an overwhelming response. So in the coming quarter, we should close this fund. We'll be making about a dozen investments of the crores range of size of investments. This business has a 15-year vintage, and the first fund had returned money at an IRR of 28%. So we are very excited about the prospects of and the investment opportunities that this business has been offered, and we continue to announce in the coming quarters our traction on deployment of these proceeds. As I speak to you, there are almost 4 transactions that have already been finalized, and you will see updates on those in the coming quarters. So that's the growth capital side of the business. As far as the real estate side of the business is concerned, that also has had a very spectacular track record. By vintage, it is also 15 years old, and we are in the process of also filing and raising a fund in the second half of this year as far as the real estate funds are also concerned. We've not had any delinquency through the poor real estate cycle in the last decade, and returns have the gross IRRs have been of the order of 20% in that business. The net IRRs, net of taxation, also have been superlative compared to any other alternative avenues that are available out there. So basically, both the businesses are very large in terms of their ability to scale up, but we have chosen to scale them up only gradually so that the performance delivery is not impacted. And you will see us announcing fundraisers almost on an annual basis, and deployments as and when we do them, you will see us making those announcements on a quarterly basis. Your second question was about the home finance. Yeah, so the outlook of the mortgage finance business continues to be quite positive. You know that the HDFC Limited affordability index is at a decadal best as incomes have grown and real estate prices have been stagnating to lower. And so we think that volumes will improve. The sentiments have also improved. You must have seen the new house registration data across all the key cities. We believe that the same impact will be reflected in the affordable housing business also, but maybe with a little lag given the impact of COVID on jobs in general. But I think the market itself is very large and we are very tiny in the overall scheme of things. And so for the mortgage business overall, we see acceleration, notwithstanding the marginal rise in rates. We also don't see rates really rising too much. You must have already seen commodity prices come off. So we are optimistic on the overall mortgage business growth, affordable housing growth, and our own growth in particular, given how small we are and how well positioned we are both in terms of the liability franchise as well as our wide distribution network of over 100 branches, all India.
Thank you so much. I'm satisfied with the answer. Thank you so much. Have a nice day.
Thank you. As there are no further questions, I now hand the conference over to Mr. Shalibhadra Shah for closing comments.
On behalf of Motilal Oswal Financial Services, I would like to thank every participant for attending the Q1 FY23 con call. If there are any further queries, please do get in touch with me or our investor relations desk. Thank you and have a good day.
On behalf of Motilal Oswal Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. The conference is no longer being